In previous lecture, we discussed there are 5 main areas of our syllabus of AAA. One is audit report, ethical and other professional issues, audit planning and risk, non-audit engagements, and matters plus procedure or evidence. And we started our first area of AAA, that is audit report. Till now, we have discussed some auditing standards. We have discussed ISA 320 materiality, ISA 700 standard worded unmodified report, 705 qualified report, 706 modified report with a paragraph, 701 key audit matter CAP, 720 other information, 580 written representation, 570 going concern. So these auditing standards we have covered in previous two classes. And today we are going to continue from the previous classes. Whatever the topic we have discussed in previous classes, we are going to continue with those topics. Mean the area of audit report we are covering. Probably will be able to finalize this audit report area in today's lecture. So let's move towards a question called Darren. Darren. It's a 20 marks question. There is part A of the question, part B of the question, part C of the question, and there is one requirement for all the parts. Discuss the implication of the matters described above. Discuss the implications. Implications mean issues relating to the matters described above on the completion of the audit and on the auditor's report. Mean you need to provide effect on the audit report. Mean in these matter, what kind of report auditor should issue. Recommending any further action which should be taken by the auditor. Further action mean what auditor will perform further. Further action mean what procedures auditor will perform, mainly relating to any discussion or inquiry with management relating to these matters. Mean whether we need to ask the management regarding amendments in financial statements or not. That is what further action. So we need to discuss the issue in the matter. We need to provide the audit report effect. And for each matter, we need to provide further action. And there are three matters that we need to deal separately, because each matter is having separate marks. Part A for 8 marks, part B for 6 marks, and part C for 6 marks. You are manager in audit department of Nijay and Company, a firm of chartered certified accountants, responsible for the audit of Darren Company, a new audit client operating in construction industry. Darren Company's financial year end on 31st January 20x5. Year end is 31st January 20x5. And the draft financial statements recognize profit before tax of $22.5 million. In company, profit is $22.5 million, while previous year profit was $20 million. Why we are having this information? Materiality calculation. And total assets of $370 million, including cash of $3 million. Mean out of these 370 total assets, cash is $3 million. There could be some reason for defining cash balance separate. The company typically works on 3 construction contracts at a time. What company does? They construct buildings. So at a time, they work on 3 construction contracts. The audit is nearly complete and you are reviewing the audit working papers. Mean audit work has been completed, but the audit report has not been signed. Mean you are in the final audit. The audit senior has brought several matters to your attention. Matter A, matter B, and matter C. Matter A. Before moving towards matter A, let's revise accounting standard IFRS 15. Revenue from contract with customer. Revenue from contract with customer. I mean, this standard is mainly on revenue. According to IFRS 15, the auditor should recognize revenue. The company should recognize revenue when risk and reward of the item or asset has been transferred to the buyer. When risk and reward has been transferred. When we transfer the risk and reward, when we have delivered the goods to the buyer. Suppose a company received order on 28th of December. Company delivered the goods on 5th of January. Whether we should recognize revenue on 28th of December or 5th of January. 5th of January, because we are transferring risk and reward relating to the inventory. When on 5th of January, mean on 5th of January, the goods are moving from our ownership to the buyer ownership. But this risk and reward transfer term, it's relating to old accounting standard, and there was old accounting standard on revenue that was IAS 17. The new standard on revenue is IFRS 15. According to IFRS 15, when we should recognize the revenue, we should recognize the revenue when performance obligation arises. When performance obligation arises. Performance obligation arises mean when we transfer the risk and reward of the goods to the buyer. Or according to IFRS 15, we should recognize revenue according to 5-step model. What are the 5 steps model? Number 1, identify contract with the customer. Contract mean legal agreement between buyer and seller, and in an agreement there must be offer and acceptance, and both parties must be willing, and there must be some consideration. Consideration means you are giving the goods and other party is giving money. Number 2, identify performance obligation. Identify performance obligation, and performance obligation could be more than one. Like we are selling computers. To deliver computer is one performance obligation. Along with the computers, we are also providing maintenance service of the computer for next 1 year. So that maintenance service is a separate performance obligation. So you need to identify contract with the customer first, and then you need to identify performance obligation, either one or more than one. And number 3, identify contract price. Mean what price you have agreed with the customer relating to one or all the performance obligation combined. Means suppose we have signed a contract with the customer of $420. In that $420, we are delivering computer as well as maintenance contract. When we signed the contract with the customer, we signed the contract with the customer on 1st of August 2024. Our year end is 31st December 2024. And this maintenance contract is for complete year. Mean we'll provide maintenance services of the computer for complete year, and we charge the customer 420, including cost of computer, price of computer, as well as maintenance contract. So first, there is a contract, yes. There is a performance obligation, yes. There are 2 performance obligation: delivering computer and providing maintenance services. What is the contract price that we have charged to the customer? 420. Now number 4, allocate 322. We allocate contract price to each performance obligation. Now we need to see out of this 420, how much is price of computer, how much is a maintenance contract. Suppose out of this 300 is relating to computer and 120 is relating to performance maintenance contract. Now number 5, recognize revenue. How we should recognize revenue? This 300 computer that we have delivered on 1st August, mean during the year, that 300 we will charge complete as revenue. But this 120, this is for 12 months maintenance services. How many months we have provided services in the current year? If our year end is 31st December, August, September, October, November, December, 1st August, 5 months. This means out of this 120, we need to charge 5 by 12, and that is what? 50. So this should be our revenue that we need to recognize in current year rather than 420 complete. The remaining 70, 120 minus 50, the remaining 70, we should recognize as deferred income. Deferred revenue, where under current liabilities in balance sheet. Because this is our obligation. Either we need to provide the services in future or we need to pay back the money. So if we have received 420 from the customer, we cannot record 420 as revenue. First, we need to identify contract. Then we need to identify performance obligation. Either there is one or more than one. We need to identify contract price and then allocate contract price to each performance obligation. How it is allocated? 300 for the computers, 120 for the maintenance. Now recognize revenue according to the current year. So computer risk and reward has been transferred during the year, so complete revenue we need to record. But for maintenance, we have delivered services of 5 months in current year, not for the 12 months. So 5 months we need to recognize revenue, and remaining revenue that we have received above, the difference between these two, 70, that will be recorded as deferred income. This is about revenue. IFRS 15 also covering another topic called construction contract. In past, there were two standards. One was IAS 17 on revenue, and other standard was IAS 11 on construction contract. They combined both standards and name it IFRS 15, revenue from contract with the customer. What is construction contract? This standard is applicable. This topic is applicable on a companies who are constructing building, who are operating in construction sector. Obviously, they are constructing a building, and building could be long-term project. Like they have started as construction of building, and that is a 5-year project. If it is a 5-year project, mean more than 1 year, how we should recognize revenue? Either we should recognize all revenue in first year, either we should recognize all revenue in last year, either we should recognize revenue divided by 5 over the years. No. In case of construction contract, we should recognize revenue according to percentage completion of work. In how much work you have completed in a particular year, out of total revenue, that percentage we need to recognize revenue in that year. Suppose total revenue agreed with the customer was $1,000. In year 1, suppose we have completed 18% of work. So 18% of this will be recorded as revenue in year 1. By end of year 2, we completed 40% of the work. How much? 40%. This means 18% was relating to previous year. Remaining 22% revenue we should recognize in year 2. Until now, we have recorded 40% revenue in both the years. So revenue should be recorded according to percentage completion of work. And cost should be recorded as per actual incurred in the year. Whatever the cost you have incurred in the year, record those costs in that year. Total cost was, say, 700,000. In first year, we just incurred 50. Record 50 in year 1. In year 2, we incurred 300. Record 300 in year 2. In whatever the cost you are incurring, paying, spending in the year, record in that year. But revenue according to percentage completion of work. Are you with me? And profit will automatically be reflected. If there is no information of revenue and cost, there is information of profit only. Profit should be recorded evenly over the period. If there is no information of revenue, there is no information of cost, we know there is a profit of 100. 5-year project, how we should recognize profit? 20/20 each year. So revenue according to percentage of completion of work, cost actual incurred in the year, and profit should be distributed evenly over the years. There's one more thing in construction contract. Every year, we need to check the profitability criteria of this contract as well. How to check profitability criteria? Total revenue minus cost to date, mean the cost that we have incurred till now, plus further cost to completion. In how much further cost we need to incur till completion date. Suppose total revenue was 1,000. Till now, we have incurred cost of 700. And currently we are at year 4 end. And we estimated to complete this project, we need to incur 400 more cost. This means revenue is 1,000. Total cost of the project will be how much? 1,100. This means by 100, this project is what? Loss making. If we are aware this project is loss making, we need to create provision for the amount of loss. In case of construction contract, mean long-term contract work in progress, revenue should be recorded according to percentage completion of work, cost actual incurred in the year, profit evenly over the time period. And we need to check profitability criteria every year. If it is becoming loss making, or we are aware this project is going to be loss making, the loss amount we need to create provision immediately in the current year. Now moving towards this part A. We need to discuss the issue. If there is any accounting standard involved, we need to discuss. We need to provide effect on the audit report. And further action mean any discussion, any requirement from management that we need to discuss as well. It's part A of the question. Part 8 good marks. 8 marks. This means we need to answer in 8 good points. Karen company is working on a major contract relating to the construction of a bridge for flyover company. Work started in July 20x4. Our year end is 31st January 20x5. This means this was started from 1st February 20x4. Is that in our year is from 1st February 20x4 to 31st January 20x5. So the work started on 1st July. 1st July means during the year. How many months before year end? 7 months before year end. And it is estimated that the contract will be completed in September 20x5. And this contract is for how many months? 1st July till next June, 1 year. And then July, August, September, 15 months contract. So contract life is 15 months. But in this year, how much time period is completed? 7 months. 8 months after year end, 7 months before this year end, because this year end is 31st January. Okay. The contract price is 20 million revenue. That should be recognized according to percentage completion of work. Is that? And it is estimated that a profit of 5 million will be made on completion of the contract, and it is of 5 million profit. That should be evenly distributed over the year. If there is cost information, then we'll recognize revenue according to percentage completion of work, cost actual incurred, profit automatically reflected. The full amount of this profit has been included in the statement of profit or loss for the year ended 31st January 2015. No. They have recorded complete 5 million profit in current year, while current year profit is how much? 5 million multiplied by 7 by 15. How much is that? 5 million, take the figures in thousand. How much is 7 by 15? 2 point.
2,333.
2 point.
2,333.
2.3 million is relating to current year. This means remaining 2.7 million is relating to next year. This means profit for the year is overstated by 2.7 million. Is that? And if we check this, the reality of this 2.7 million against 22.5 million are profit. It is about 9% or 11%. %, and highly material. Is that? We should discuss with management regarding the adjustment required in the financial statement to understate the profit by $2.7 million. That's it. Darren Company management believe that this accounting treatment is appropriate, given that the contract was signed during the financial year and no problem have arisen in the work carried out so far. So you signed the contract in this year, but the complete profit is not relating to this year because this contract is for 15 months. So profit should be distributed evenly over the time period. How many marks are there? 8 marks. So first, we will say as per IFRS 15, the profit relating to construction contract should be distributed over the time period of the contract. 5 million profit company have recorded in current year, while in current year it should have been recorded 2.3 million rather than 5 million. Only 7 months work is completed in current year. Profit is overstated by $2.7 million, which is 12% of profit and hence material. How many points? 3. We need to discuss with the management regarding the adjustment in financial statements like profit should be written down by $2.7 million. If management do not adjust the profit, the matter is material. Auditor should issue qualified report with except for opinion. How many points we have discussed? 5. And while attempting this question in the exam center, students attempted this part in 5 points. How many marks are there? 8. To pass from this part, we need 4 marks. And if we have provided 5 points, it is very difficult to pass this part. What else we can discuss for 3 marks? Except this, what we can write down? Nothing. We have explained the standard. We have provided the amount that should have been recorded. We have discussed how much is overstated. So we need to discuss with management regarding amendments, and we have provided the reporting effect. Now we can cover 8 points. There was some information in first paragraph, end of first paragraph. Company typically works on 3 construction contracts at a time. This is relating to one contract. If for the other contract, company is also recognizing revenue and profit as per this policy, then other contract profit might also be overstated. And if we combine both, all the contract profit, this could have created pervasive effect rather than material only. So in that case, adverse opinion will be issued rather than qualified. So these 3 points we need to discuss separate. Now we'll be able to convince our examiner. We have discussed each and every point. Now please award 8 marks. Please. You cannot cut even a single mark now. If we ignore this point, we have answered for 5 marks. It's on examiner whether he will give 5 marks, passing 4 marks, or 3 marks. 3 marks. We will easily fail this paper in 40s. So we are adopting an approach how to attempt this paper according to marks. 8 marks, 8 valid points we should written down in the answer sheet. 6 marks, 6 valid points. 5 marks, 5 valid points. Part B of the question for 6 good marks. A significant contract was completed in September 20X4. Before year end, 31st January 20X5. In 4 months before year end. This contract related to the construction of a 20-mile highway in a remote area. We constructed a highway. That was the contract that we completed during the year. In November 20X4, 3 months before year end, several large cracks appeared in the road surface after a period of a unusual heavy rain. In just after 1 month, the road got some cracks due to rain. Could be we didn't use the proper quality material. And road had to be shut for 10 weeks while repair work was carried out. New build company paid for these repairs, but has taken legal action against Darren company to recover the cost incurred of $40 million. So the company is facing a claim from the customer due to negligent work that is of $40 million. If it is meeting three conditions of provisions per IAS 37, present legal constructive obligation from past event, probability of future economic outflow, and amounts can be measured liably, that is 40 million claim they have made, there must be provision. But if there is possibility, there should be contingent liability disclosure. Let's see. Disclosure on this matter has been made in the notes to the financial statements. What management does, they haven't created the provision, they provided a disclosure in the financial statement. Audit evidence, including a written statement from Darren Company's lawyer, concludes that there is a possibility, not the probability, of Darren Company having to settle the amount claimed. If there is a possibility, then there must be contingent liability disclosure. Is that? So first, we should explain the matters like company is receiving a claim of 40 million from the customer due to defective work relating to the road construction. Is that? For IAS 37, if it is meeting three conditions of provision, there must be provision recognized. But as per lawyer, there is a possibility rather than probability, so requiring contingent liability disclosure in the financial statement. Is that? So we need to discuss with management regarding the application of IAS 37 and disclosure of contingent liability in the financial statement. Might be they have provided normal disclosure, but no, there must be disclosure of contingent liability per IAS 37. Is that? How much is the claim? How much is the claim? $40 million. There was some information about company cash balance. $3 million. If management have provided appropriate disclosure of contingent liability, audit opinion should be unqualified. But the claim is of 40 million. If company loses this case and company need to pay back this 40 million, company is having how much cash? $3 million. This could create serious cash flow issue for the company, which must be disclosed in the financial statements per IAS 1. And if management had disclosed cash flow issue, audit opinion must be unqualified, but material uncertainty relating to going concern paragraph should be included in the audit report to highlight the disclosure. Material uncertainty relating to going concern paragraph, MURGC. Material uncertainty relating to going concern that we have discussed in previous class, I think so. Now we'll be able to tackle this part for 6 marks. Without discussing this material uncertainty cash flow issue, we have attempted for 4 marks, not for 6 marks. Part A, part B. Now part C. That is very difficult to prepare 6 good points. It's part C for 6 marks. For the first time this year, financial statements are presented as part of integrated reports. Integrated reports. Integrated reporting concept says a company, while preparing its annual reports, should not only report the result of financial transaction in financial statement, company should also report the impact of its transaction on the society and on the environment. Along with the financial statements, you need to provide social and environmental responsibility reporting as well. In the impact of company financial transaction on the society, either you are impacting the society in a positive way or negative way. If in negative way, how you are recovering that damage, you need to prepare a report and provide in the annual report. The main focus, you need to perform social responsibilities. The impact of company financial transaction on the physical environment in terms of pollution, in terms of CO2 emission, in terms of use of resources. Either you are impacting the environment in a positive way or negative way. If negative way, how you are repairing the environment, how you are performing environmental responsibilities, you need to prepare a report and provide in annual reports. Not only you should provide financial statements, you should provide social and environmental responsibility reporting as well. This is what integrated reporting. And if company is providing social and environmental responsibility report in annual reports along with financial statement, being auditor, we should audit financial statement. But this social and environmental responsibility reporting is what? Other information. For ISA 720, other information, we should read or review this other information, but do not audit. And to see whether this other information is consistent with the financial statement or not. If it is consistent, we must highlight there is no material misstatement of the information. If it is inconsistent, we should highlight it there is material misstatement of the information. As well as in other information paragraph in the audit report, we need to say it is our responsibility to read this other information for IS 720, but do not audit. And our audit opinion is on financial statements rather than this other information. What's going on here? For the first time this year, the financial statements are presented as part of an integrated report. Included in the integrated report are several key performance indicators. If company have decided, okay, we should move towards performing social environmental responsibilities, they set their social targets and environmental targets. Social targets like we need to provide charity to the society 10% more than previous year. We should spend this much budget on training of the employees. This is what social responsibilities. We should distribute this much sample, this value sample in the society this year. We should reduce CO2 emission by this much in this year. We should spend this amount on recycling. We should spend this amount on reproduction of resources. And those targets are called KPIs. Key performance indicators that company define at the year end. At year start, at year end, they measure whether we have meet these KPIs or not, and then they prepare a report and publish where in annual reports. Sometimes auditor is asked to verify this KPI report as well. This is another assignment other than audit called non-audit engagement. So what's going on here? For the first time this year, the financial statements are presented as part of the integrated report. Integrated report means other than financial statements, there is some other information like social environmental reporting as well. Included in the integrated report are several key performance indicators, KPIs, one of which state that Darren company profit before tax has increased by 20% from the previous year. In social responsibility. Social responsibility means considering best for the society. Society means stakeholder, stakeholder means shareholder, investor as well. Companies are saying we have increased profit by 20% as compared to previous year. There was some information about profit. Current year profit is 22.5 million, while previous year profit was 20 million. Can you see how much is increase? Current minus previous over previous multiplied by 100. I think so. This is increased by 13%. While they are saying how much profit has been increased, this means this other information is not consistent with the financial statement. So we should discuss with management regarding the amendments in other information as the increase in profit is 13% rather than 20%. If they do not change this other information, we should highlight in other information paragraph in the audit report, there is a material misstatement in other information. As well as we should highlight to read or review this other information is our responsibility per ISA 720, but do not audit. And our audit opinion is not influenced by this other information. These points we need to discuss for 6 good marks. Need to discuss, highlight through other information paragraph, as well as we need to highlight read reviews our responsibility to audit. We need to highlight our audit opinion is not influenced by this other information. And first we need to explain the issue like integrated reporting. Companies are providing social environmental reporting. In that they have stated profit has increased by 20%, while financial statement is showing 13% increase in profit. This means this other information is inconsistent. So these are 6 points we need to discuss. This is the most difficult part to score 6 marks. Student did, they just discussed, oh, there is inconsistency, so we should discuss with management regarding the change. If they don't change, so we should highlight through other information paragraph. In 2 or maximum 3 points they made. But we need to cover 6 marks. We need to discuss what should be in the other information. What is other 2 points? We need to explain the matter as well. So it's a very good question for practice to adopt an approach how to discuss any issue along with audit report as well as further action. So let's move forward towards discussing more auditing standards. So we are going to discuss an auditing standard ISA 560. Subsequent event. Before discussing this ISA 560 subsequent event, let's discuss about IEA stand. What was IEA stand? Events after reporting period. Who prepare financial statements? Who prepare financial statements? Company management. So if they are preparing financial statements, they need to follow the accounting standards. Is that? In those accounting standards, there is accounting standard IAS and events after the reporting date. And according to this accounting standard, events after the reporting date, management need to identify adjusting and non-adjusting events between balance sheet date mean year end date, and date director approve of financial statements for issue. Company do not issue financial statements at year end. They issue financial statements probably after 2 to 3 months of the year end at AGM. So while preparing financial statements, company management need to identify adjusting and non-adjusting events between the date financials year end and director approve financial statements for issue. The events occurring after the approval means signing of financial statements will be neither adjusting nor non-adjusting. They will be relating to next year. For adjusting events, they need to adjust the financial statement because their condition exists at the year end. There is any account balance in the financial statements that need to be added or subtracted. Like here at year end, they have recorded a receivable. Here they got knowledge that a customer become bad, become insolvent. So this is adjusting event. We need to record bad debts provision. We need to reduce the receivable and record the expense. Otherwise, asset profit will be overstated, expenses understated. Here they have recorded an inventory on cost basis because cost was lower than NRV. After here, they realize we are going to sell that inventory below cost. I mean, we recorded inventory on cost $10 per unit, but now they are able to sell that inventory at $6 per unit. This means NRV is lower than cost. The inventory recorded in balance sheet is overstated. For IAS 2 should be recorded on lower of cost and NRV. So they need to adjust the inventory. This is what adjusting event. Non-adjusting event mean here they are aware that a company destroyed one of the assets due to fire. So this loss is relating to next year because this year has ended here. This loss will be reflected in next year financial statements. But as you are aware about it before issue of current year financial statements, so you must provide disclosure in the current year financial statement. Here, after year end, company acquire any other subsidiary. So next year financial statements will be consolidated financial statements, including the result of this subsidiary. As you are aware about it before issue of this year financial statement, so you must provide disclosure in current year financial statements as a non-adjusting event. This is IAS style. We are studying audit. We are just revising accounting standards. In audit, auditor is having some responsibility relating to post year end period. Management is having responsibility relating to post year end period. That period is only one period from year end date till directors sign approve financial statements for issue. In that period, they need to identify adjusting, non-adjusting events. But auditor is also having post year end period some responsibilities, but not relating to one period. Auditor is having responsibility relating to 3 different periods. The first period is what? Year end date, mean balance sheet date, till audit report sign date. We will call it period 1. And this period is similar to IAS 10 period because one day directors sign the financial statements for issue. On the similar day or the very next day, we sign the audit report. We do not sign the audit report before directors sign financial statements and approve financial statements because our audit report is on financial statement. So this is similar to IAS 10 period. Auditor is having some responsibility for a period audit report signed till financial statements issued, mean audit report issued, where company issue financial statements audit report at AGM. We will call this period as period 2. Auditor is having some responsibility even after issuance of financial statements audit report, and we will call it period 3. So let's discuss what are auditors' responsibility relating to period 1, period 2, and period 3. If we discuss about period 1, that is our final audit period. Mean audit were performed after the year end has finished. From year end till signing audit report, what is this? This is called final audit period. Whether auditor is active or passive in this period. Active, obviously, he is performing active audit procedures. He is checking sales return, purchase return after the year end to perform cut-off testing. He is receiving written representation from management relating to some matters where in final audit period. Is that he is checking receivables through cash receipt. He is checking payables through cash payment. He is confirming receivable balances from the customer. He is confirming leases, back cash at bank from the bankers. So he is performing active audit procedures. If in period 1, auditor is aware about any misstatement in the financial statement, what he should do? He should ask the management to amend the financial statement. He should ask the management to amend the financial statements. If management do not amend the financial statement, auditor should issue qualified report, because report is not signed yet. It's in his hand. If he is finding any misstatement, he should request the management regarding amendment in the financial statements. If they do not amend, auditor should qualify the audit. Simple. Now let's discuss about period 2. What is period 2? Audit report has been signed and given to the company management, but it's not issued yet. It's still in the hand of company management. They are going to take copies of that audit report so that they can attach in the annual reports and issue along with financial statement. I mean, they are waiting for AGM where they will issue financial statements along with audit report. Is that auditor active or passive? Passive, because audit work has been completed. If he has assigned the audit report, audit work has been completed. He is passive. But auditor must be alert regarding any information. Suppose in period 2, auditor is aware through some sources, like the financial statement on which he has given audit report. There is a misstatement in those financial statements that he haven't identified in this period. This means auditor is aware the financial statements that are going to be issued are inaccurate. There is a misstatement. This means financial statements are inaccurate. Our audit report could be also be inaccurate. If we have issued unqualified opinion, while financial statements are wrong, this means our audit opinion is inappropriate. So before company management issue wrong financial statements, wrong audit report, we should take some action. What action we should take? We should ask the management to amend the financial statement. We are aware the financial statements contain this misstatement, so please correct and produce new financial statement. Corrected financial statements that must be issued. If management agree, okay, we're gonna correct the financial statements, we're gonna produce new financial statements. What auditor should do? He should assign a new audit report after the approval of amended financial statement, so that the correct financial statements and correct audit report should be issued. If management do not amend the financial statement, only new report we cannot issue because our report is on financial statement. In that case, what we should do? We should discuss the matter with the shareholder at AGM where company is going to issue financial statement audit report. We should inform the shareholder regarding the misstatement in the financial statements, and we should withdraw from our audit report. Withdraw from our audit report. In this financial statement, this audit report is wrong. This is the issue that we couldn't find till signing the audit report, but after that, we are aware about that. We discussed with the management, they didn't correct it. So we are going to withdraw from our audit. So in period one, if auditor is aware about any misstatement in the financial statements, we should ask the management to amend the financial statements. If they do not amend, we should qualify the report because it is not signed yet. But in period two, audit report has been signed. Audit work has been completed. If we are aware about misstatement in the financial statements that is going to be issued, before management issue wrong financial statements, wrong audit report, we should take some steps. We should request the management to amend the financial statement. And we should issue new audit report on the amended financial statement. If they do not amend, auditor should consider speaking of the matter to shareholder at AGM and withdraw from his audit. This is auditor responsibility related to period. Now let's discuss period 3. Financial statements audit report has been issued. It is with public. They are using that. They are making a decision based on those financial statements audit report. Some might have already taken decision. Auditor is active or passive? Passive, obviously. But if auditor is aware through some sources, some information, the financial statements that has been issued by the company management contain any material misstatement that was not identified in this period. This means if financial statements are wrong, our audit opinion, audit report is also wrong. We are aware about this. Before this information is moving towards public, they will be claiming damages from us. We should take some steps to save ourselves. What we should do? We should quickly call up meeting with the company management and request them. We are aware the financial statements contain this misstatement that we couldn't identify, but we are aware now. So now you should please issue revised financial statement. The statement that has already been issued, if you are going to issue its corrected version, that corrected version is called revised version. I mean, the name of financial statements will be what? Revised financial statement. And we will ask the management in revised financial statements provide a disclosure in which you should explain reason behind the revision, why you are issuing revised financial statements. What is wrong in previous financial statements? Disclose, provide a disclosure. And if management agree, okay, we're gonna issue revised financial statements with proper disclosure. Being auditor, we should issue new audit report, and audit report name will also be revised audit report. In that revised audit report, we will also explain why we are going to issue a revised audit report. How we can explain? By highlighting this disclosure. How we can highlight any disclosure in the financial statement? Emphasis of matter paragraph. In period 3, when financial statements audit report has been issued to the general public, and we are aware the financial statements that has been issued, that public is using, contain some material misstatement that was not identified during audit. Now, before this information is moving towards public, they are claiming damages against us due to negligent work. We should request management immediately to issue revised financial statements with the disclosure explaining the reason behind revision of financial statements. And we being auditor must issue revised audit report with emphasis of matter paragraph to highlight that disclosure explaining reason behind the revision. If management do not issue revised financial statement. What we should do in that case, we should take legal opinion, and we should consult a lawyer how they could save us from the damages, and we should try to speaking of matter to shareholder. If we are the auditor for the next year as well, we can resign and call EGM, because we discussed with management, they are not accepting our advice. So we are resigning from the next audit and calling an EGM to discuss matter with the shareholder. Or we can discuss with the shareholder through any of the, what you can say, press conference. Or whatever the lawyers is recommending, we should follow that path. How we can avoid losses, how we can avoid damages claim from the investor, from the user of the financial statement audit report. So per ISA 560, subsequent event auditor is having some responsibilities relating to events after the year end. As per accounting, management is having responsibility relating to one period, but auditor is having responsibility relating to 3 different periods. Period 1, from year end date till audit report signed, auditor is active, performing active audit procedures. If he has identified any misstatement in the financial statements, he should request the management to amend the financial statements, to correct the financial statements. If they do not amend, auditor should issue qualified report, because it's not signed yet, it's not issued yet. Everything is in the hand of auditor. Period 2, audit report has been signed but not issued. It is in the hand of company management, not in the hand of public. And if auditor is aware about a misstatement in the reported financial statements, he should request the management to amend the financial statements, mean prepare new. An auditor should sign a new audit report after approval of new financial statement. If management do not amend the financial statements, auditor should consider speaking of matter to shareholder at AGM and withdraw from his report. Period 3, financial statements audit report has been issued to the general public. If auditor is aware about a misstatement in the reported financial statement, he should immediately request the management to issue revised financial statements with the disclosure explaining the reason behind the review. And auditor should issue revised audit report with the emphasis of matter paragraph to highlight that disclosure. If management do not revise the financial statement, auditor should take legal opinion and consider speaking of matter to shareholder. Now, adding one more point. If in period 3, auditor is aware about the misstatement in financial statements, but too late. Too late means coming year financial statements are going to be produced. There is no time for producing revised financial statements relating to previous year, because until that time, coming year financial statements is new to produce. Then we should not request the management to issue a revised financial statement. We should recommend the management, instead of issuing revised financial statements, provide prior year adjustment in coming year financial statement. Adjust the coming year financial statements opening balances that was given from the previous, those are wrong, and provide a disclosure in coming year financial statements. These were the prior period errors or misstatements that has been corrected in current year financial statement. Revise the comparative mean previous year figures, and provide a disclosure mean why we have changed the previous year figure, mean what is the, if there was no any expense recorded, record in current year, provide a disclosure, something like that. But with this prior adjustment in coming year financial statement, it could affect profit significantly. And if it is affecting profit significantly, shareholder could be out of control. I mean, you did this deliberately in previous year. Now you are reflecting those issues in current year. So before shareholder is checking these things in the financial statements, we should inform the shareholder regarding this adjustment is going to be made in coming year financial statements. And informing the shareholder regarding this adjustment in coming year financial statements is called issue press release. Press release means inform the shareholder regarding the adjustment in coming year financial statements, so that they must be prepared, they must be known about this adjustment going to be made in coming year financial statements. Because if they will see suddenly in financial statements, they will be out of control. You will not be able to control them. They will kick you out. So prepare their mind before this adjustment is going to be happen. So if the misstatement in period 3 is coming to auditor knowledge too late, I mean, there is no time for preparing revised financial statements because the coming year financial statements is imminent, mean near to produce. So if you request the management, do not issue revised financial statements. Adjust this misstatement as a prior adjustment in the coming year financial statements, and we should request the management to issue press release. Press release, instead of press release, there is a term called profit warning. Mean inform the shareholder regarding this adjustment. Mean this adjustment could have impact on the coming year profit. So that they must be prepared about this adjustment. So this is what ISA 560 subsequent event. Though this topic is mainly relating to AA paper, because in every AA paper, examiner paper is incomplete without testing this topic subsequent event. But we see it is part of AAA as well. That's why we have studied. Okay, let's discuss two small auditing standards. Then we'll move towards some questions and we'll wind up reporting section. So moving towards two more auditing standards. ISA 510. Till now we have covered ISA 320 materiality, 700 audit report, standard worded, 705 qualified, 706 paragraph, 701. In these four standards are relating to report 701 CAM. Other information 720 we have covered. 580 written presentation we have covered. 570 going concern we have covered, and 560 subsequent event we have covered. 510 opening balances. ISA 510 opening balances. Mean how to verify opening balances. Opening balances mean balances that are coming from previous year. In previous year closing balances are called opening balances. This standard will be applicable if we are conducting audit of any company for the first time. If we were the auditor in previous year, this means previous closing balance we have verified. This means opening balances we have also verified. Just we need to compare current year opening balances with previous year working paper and financial statements. Is that? But if we were not the auditor in previous year, then we should verify opening balances as well. Now, first we should check the balance brought forward. What are the balance brought forward? We should compare with the previous year financial statements to identify any difference. We should make sure consistency of accounting policies applied. I mean, accounting policies that company were complying in previous year, companies complying the same accounting policies in current year. Then mainly we need to discuss the reporting effect. If previous year audit report was qualified, Why? Because previous closing balance was misstated. That's why qualified. The previous year audit report was qualified. We should make sure whether the matter on which report was qualified has been resolved or not resolved. If the subject of the previous year qualification has not been resolved, so we need to check whether that misstatement creating a material effect in current year, we will qualify current year report as well. Are you? The previous year audit report was qualified. Mean there was material misstatement. This means previous year closing balance was misstated. That is coming as a opening balance in current year misstated. If that balance is material as compared to current year financial statements as well, matter has not been resolved. This means current year financial statements are also materially misstated. We should issue qualified report. But if the matter has been resolved, if the matter has been resolved, me correct it. In that case, unqualified opinion for the current year. Are you? When we are applying ISA 520, 510, when we are going to conduct audit for the first time, if we are going to conduct audit for the first time, previous year financial statements are audited by any other firm or not audited, we should always highlight through other matter paragraph. If prior year financial statements were not audited or audited by any other firm, we should always highlight through other matter paragraph. ISA 510 finish. I've shared two notes in Teams. One is relating to audit report notes. One is relating to P7 notes. It's in P7 chapter 9. Let's take a break. After a break, we will discuss one more auditing standard and then we will discuss two more questions and we'll wind up this reporting area. ACC Advanced Audit and Assurance. Let's move towards one more auditing standard, ISA 710. Comparative information or comparative financial statements. For IS 1, financial statements should be prepared comparative. What does it mean by comparative? Along with the current year, previous year figures should also be stated. So if company have prepared comparative financial statements, everything is okay. If no comparative, qualified audit report, except for comparative financial statements, give 20 fair view. Is that? If reporting effect, if prior period financial statements has been revised, why revised? To correct the misstatement in already issued financial statements. If prior financial statements were revised, then this year comparative should be as per the revised. And there must be a prior adjustment disclosure. So in that case, we will issue what? Unqualified opinion. But that prior adjustment disclosure, we should highlight. How we should highlight? Using emphasis of matter paragraph. But if prior year financial statements has been revised, but the current year comparative as per previous old dirty, not as per revised, then qualified audit report. And if previous year financial statements were not audited or audited by any other firm, we should highlight using other matter paragraph. So if company have prepared comparative financial statements, unqualified opinion. If there are no comparatives, qualified opinion. If prior year financial statements has been revised, then the current year financial statements should be as per the revised financial statements, and there must be a disclosure of prior adjustment. And if everything is okay, unqualified opinion, but material, emphasis of matter paragraph should be included to highlight that disclosure. If prior year financial statements has been revised, but current year financial statements comparative are not as per revised, then qualified report. And if previous year financial statements were not audited by any other firm, we should highlight using other matter paragraph. ISA 720 we have already discussed. For ISA 720 other information, we need to read or review other information, but do not audit. If other information is inconsistent with the financial statement, if other information is inconsistent with financial statements and there is error in financial statement, then we should qualify audit opinion. If financial statements are accurate, there is something wrong in other information, So we should discuss with management to change other information. If they do not change, still there is inconsistency, we should highlight using other information paragraph. There is a material misstatement in other information. If there are some inconsistencies in other information, that we highlighted to company management and we asked them to correct them, but they didn't bother to correct. In that extreme cases, due to undoubtful integrity of client management, we can consider even withdraw from the engagement as well. There are so many inconsistencies. We ask the management, please correct this. Why you are saying this while financial statement is showing something different? But they didn't bother to correct. This means their integrity is not okay. So due to doubtful integrity of client management, we should consider, we lost confidence on director integrity. In that case, we can withdraw from the engagement. So that's the subsequent event we have already covered. Going concern we have already covered. Move towards some more questions. Sure. So there are two parts of the question. Part A for 12 good marks and part B 1 for 3 marks, B 2 for 3 marks. Part A of the question. Before moving towards part A, let's discuss another accounting standard, IAS 38, intangibles. As per IAS 38, intangibles should be capitalized and should be amortized over their useful life. Goodwill. Only purchased should be capitalized. Only purchased goodwill should be capitalized. Internally generated cannot be capitalized. Goodwill, no amortization. Why? Because the life of goodwill cannot be determined. It must be having impairment test. Brand, only purchase should be capitalized. Internally generated cannot be capitalized. Some years before, standard allowed to capitalize internally generated brand based on certain criteria, but now standard is saying internally generated either goodwill, either brand, we should not capitalize, only purchase should be capitalized. Okay. IAS 38 also covering research and development cost. Research cost, expense out, cannot be capitalized. Development cost, expense out, but if a meeting criteria should be capitalized. Development cost, expense out, but if meeting capitalized criteria, then it must be capitalized. What is capitalized criteria? There is a 6 capitalized criteria. Technical feasible, commercial viable, intention to use, complete, or sell. Not only intention, ability to use, complete, or sell, availability of resources, mainly financial resources, and the amount that you are going to capitalize must be reliably measured. If development cost meeting these 6 criteria should be capitalized, if not meeting any one of the criteria, it must be expense out. If we have capitalized development cost, every year we need to check the criteria. If in any of the subsequent year, any criteria is not fulfilled, expense out. And development cost would also be amortized over its useful life. Now, what does mean by these criteria? What is mean by technical feasibility? Realistically, company can develop this product. How, being auditor, we can verify development cost meeting technical feasible criteria? How we can verify? Before producing any product, company produce its a sample that is called prototype. So we can verify technical feasibility criteria through existence of prototype. Mean sample. If company have produced a sample, mean prototype, this mean company can produce this product realistically. If they have produced a prototype, they can produce further products as well. But if there is no existence of prototyping, no sample, this means criteria is not fulfilled. Or we can see similar products in the market. If there are similar products in the market, this means company can also produce this product. Anybody can copy everything. Is that? Commercial viability, what does that mean? Commercial viability, this product is commercially viable. Commercial viable means there is demand of this product in the market. Company will be able to generate revenue through its sale. How we can verify there is demand in the market? We can verify through market research. What? Demand in the market. Or we can verify through order book. In order received, any customer contract assigned. Saying there is demand. It's meeting this criteria. How we can verify it is management intention to use, complete, or sell this product? Being auditor, how we can verify? Through board minutes. Board minutes mean minutes of the board meeting where they have discussed about this product. Through their discussion, we'll be able to identify whether they are having intention to use, complete, or sell this product or not. Ability to use, complete, or sell. What does that mean? Companies having production capacity. Companies having the scientist who can complete, develop this product. How we can verify this? Through availability of production capacity. They are having labor. Availability of resources, mainly financial resources. How we can verify? Companies having financial resources to compete, use, even to sell, they need money for advertising. Review cash flow forecast. in future cash flow. Amounts can be measured reliably, the amounts they are going to capitalize. How we can verify it is measured reliably, realistically? I mean, all the material, labor, overheads has been incorporated into the cost properly. We can review through budget copy. In budget, they have written down what is the material per unit, what is labor per unit, what is overhead per unit, fixed, variable, and they have computed a cost. We will review that budget copy to see that cost has been calculated on realistic basis. Examiner could ask how you can verify procedures. Okay, let's move towards this question. You, part A for 12 very good marks. Discuss the implication issues of the audit senior note on the completion of the audit and on the auditor's report recommending any further action that should be taken by the auditor. Means same requirement of previous question. What was that, Darren? Issues mean accounting standard involved, effect on audit report, and any further action mean you need any amendment discussion with management. But here, part A, part 12 marks. If there are more than one issues in one heading or one requirement, we need to discuss each issue separately. In previous question, Darren, there were 3 issues, so we discussed separately. In this 12 marks, could be 2-3 issues written in one requirement, but we should deal each issue separately. Because examiner is not requiring audit report from you. He's testing your knowledge relating to the topic. So you are the manager responsible for the audit of U company, a company which design and develop aircraft engine. So company design and develop aircraft engine. The audit for the year ended 31st July 20x1 is nearing completion. 31st July 20x1. And audit senior has left the following file note for your attention. I have just returned from a meeting with the management of U company, and there is a matter I want to bring to your attention. U company's financial statement of financial position recognizes an intangible assets of 12.5 million in respect of capitalized research and development cost relating to new aircraft engine design. Company have capitalized 12.5 million intangible relating to research and development cost. Is there any information about the profit, total assets, so that we can discuss about materiality? Yes, in the last line, they have provided profit before tax 23 million and total assets to 10 million. So we can compare materiality with both profit, and it is about, in fact, more than 50% of profit. And it is even about 5-6% of total assets and hence material. So first we will discuss materiality. Then per IAS 38, research cost should be expense out. Only development cost should be capitalized while meeting certain criteria. 2 points. Okay. However, market research conducted by U company in relation to these design indicate that there would be little demand in the near future for such a design. And there will be little demand. Commercial viability criteria is not fulfilled. And management has provided written representation. They agree with the result of the market research. This means this development cost is not meeting commercial viability criteria. And despite not fulfilling the criteria, if they are capitalizing, asset profit could be overstated, expenses understated. So we must discuss with management regarding the adjustment in financial statements. regarding the criteria of capitalizing development cost. And if management do not amend the financial statement, audit opinion should be qualified except one, because the matter is material to the financial statements. So we'll write down this for 6 marks. Is that? Here's the information. Let's see. Currently, your company has a cash balance of only 125,000. Even 12.5 million cost. How much cash they are having? 125,000. It's not meeting even availability of financial resources criteria. We can add one more point. Okay. So currently your company has a cash balance of only 125,000 and members of the management team have expressed concern that the company is finding it difficult to raise additional finance. So this was relating to development costs. We'll put a heading development costs. And for development costs, we have discussed 6 points, including its reporting effect. Now we'll put the heading cash flow. Company is finding it difficult to manage its cash flow. And per IAS 1, cash flow issue must be disclosed in the financial statement. If management have disclosed this cash flow issue per IAS 1, audit opinion should be unqualified, but material uncertainty relating to going concern paragraph should be included in the audit report to highlight this cash flow issue disclosure. If management do not disclose, audit opinion should be qualified. 3-4 points we can discuss here as well. 12 marks. Still 2 marks left. The new aircraft design have been discussed in the chairman statement. What is this chairman statement? Other information. Which is to be published with the financial statement. The discussion states that development of new engine design are currently underway. And we believe that these new designs will become a significant source of income for your company in the next 12 months. While in the paragraph above, we have realized like this development cost is not meeting the capitalized criteria. And there is no demand in the market as well. Even they don't have financial resources to complete this product. So this other information is not consistent with the financial statement. Is that? So we must highlight this inconsistency in other information paragraph in the audit report. There is material misstatement, other information. We can discuss 2 points here as well. If there is further marks available, we can discuss. We should highlight it is our duty, responsibility to review this other information, but do not audit. Our opinion is not influenced by this. We can put more lines if it is required. So for 12 marks, we can answer this. We are adopting an approach how to prepare points according to marks. So part A for 12 marks we have did. And we have learned if in one paragraph there are more than one issue, we should discuss each issue separate along with its reporting effect. We should issue each issue separate along with its reporting effect. Part B of the question. Required. Part 3 plus 3, 6 marks. Respond to audit partners' comments. What are their comments? Let's see. You are responsible for answering technical queries from other managers and partners of your firm. An audit partner left the following note on your desk this morning. You need to respond for 3 marks, 3 marks separate. B1. Audit partner left a note on your desk this morning. I am about to draft the audit report for client Sycamore Company. And he is going to draft audit report for client Sycamore Company. I'm going on holiday tomorrow and want to have an audit report signed and dated before I leave, so that I can enjoy holidays properly. The only thing outstanding is the written representation from management. I have verbally confirmed the consent with the finance director, who agreed to send the representation to the audit manager within the next few days. I presume this is acceptable. Can he sign audit report before obtaining written representation? No. Auditor shall obtain sufficient appropriate audit evidence before expressing the audit opinion per ISA 500 as well as 700. And written representation is required to make the audit evidence sufficient. Without this, we don't have sufficient audit evidence. So it is not acceptable to sign audit report before obtaining written representation, though finance director have agreed, but after signing, he could deny. He could refuse to sign. He could refuse to provide. So we need to put the standard reference as well, per ISA 500, per ISA 700. For 3 marks, we can answer. Okay. Number 2, separate issue. We are auditing Sycamore Company for the first time. Oh, yes, first time. Is there any issue? Other matter, we should explain previous year financial statement not audited by any other firm, as well as we need to verify opening balances per ISA 510. The prior period financial statements were audited by any other firm. We are aware that the auditor's opinion on the prior period was qualified due to a material misstatement of trade receivables. We have obtained sufficient appropriate evidence that the matter giving rise to the misstatement has been resolved. And the matter was resolved. This means having no effect on the current year financial statement. Is that? And I am happy to issue an unmodified opinion. Yes, because the matter is resolved. But should I refer to the prior year modification in this year auditor report? No, because if the matter has been resolved, having no effect on the current year financial statements, so we should not refer to the prior modification, but we should highlight in current year audit report using other matter paragraph. Previous year financial statements were audited by any other firm per ISA 510. Per ISA 510, because we are going to conduct audit first time of this client. Previous year auditor was something different. Is that 3, 3, 6 good marks? So let's move toward one last question on reporting. After that, we'll be having enough practice of reporting. In reporting, we have covered ISA 320, 700, 705, 706, 701, 720, 710 comparatives, 510 opening balances, 560 subsequent event, 570 going concern, 580 written representation, and we have covered 500 as well. Audit evidence. So these auditing standards we have covered so far. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And we have covered 4 questions till now. We have covered one question, Mar, Snipe, Karen, you. And the 5th question we are going to cover, that is Boston. If we practice these 5 questions properly, we'll be able to handle reporting question in the exam center. Boston. Requirement A and B we need to cover. Requirement A for 10 marks and requirement B for 5 marks. Requirement A. Explain the matters. Matters mean materiality, accounting standard discussion, along with misstatement if they have adopted wrong approach, which should be discussed with the management in relation to each of the uncorrected misstatement. And there are some uncorrected misstatements. We need to discuss matters relating to those misstatements, whether the amount is material or not, whether what accounting standard is involved, what they say, what they have done, including an assessment of their individual impact on the financial statement. And we need to discuss impact on the financial statement as well. Impact of financial statements, whether it is creating material misstatement, pervasive misstatement, or what's the issue. 10 marks. So you are the manager responsible for the audit of Boston Company, a producer of chocolate and confectionery. The audit of the financial statements for the year ended 31st December 2025 is nearly complete, and you are reviewing the audit working papers. The financial statements recognize revenue of $76 million, profit before tax for the year of $6.4 million, and total assets of $104 million. Revenue, profit, and total assets. The summary of uncorrected misstatements included in Boston Company's audit working papers, including notes, is shown below. Uncorrected misstatements summary. The audit engagement partner is holding a meeting with the management team of Boston Company next week, at which the uncorrected misstatements will be discussed. Summary of uncorrected misstatements. Impairment. There is 400,000 debit required in statement of profit and loss, and 400,000 credit is required in statement of financial position. In this, correction is required. This means, if you see, might be there was an impairment of asset that was not recorded. If not recorded, this means now 400,000 expense is required in P&L as a debit, and 400,000 credit is required in balance sheet, mean deduction from the asset. Is that okay? Number 2, borrowing cost. For borrowing cost, 75,000 credit is required in P&L and debit is required in balance sheet. Might be this borrowing cost meeting the capitalized criteria, but they have expense out, interest. This means that expense you need to reduce by crediting the P&L and should be recorded as capitalized asset. That's why it required debit in balance sheet. Is that? It might be it was meeting capitalized criteria relating to asset, but they have expense out. So now what's the correct treatment? That expense we need to reduce credit and we need to add to the asset debit. Let's see. Irrecoverable debt, note 3. Bad debts. 65,000 debit is required in P&L, mean expense. And 65,000 credit is required in balance sheet mean reduction from receivables. It might be company haven't adjusted the bad debts. That's why expense and reduction from asset is required. Let's see. Investment. Investment. 43,500 credit is required in P&L. P&L, we debit expense, credit incomes. Could be this is the income of investment that was not recorded. And 43,500 debit is required in balance sheet means should be added to investment asset. It might be this income from investment is not recorded. Let's see. Regarding impairment, there is note 1. During the year, Boston company, so there are 4 different issues. Is that? So first issue is relating to impairment. So we'll put the heading number 1, impairment. What is the standard on impairment? IAS 36. For IAS 36, impairment should be recorded when asset carrying value is higher than recoverable amount. And carrying value is higher than recoverable amount. Means carrying value is 100, recoverable amount is 80. So how much impairment is required? 20. What is it by recoverable amount? What does it mean by recoverable amount? Higher of recoverable amount mean higher of fair value less cost to sell and value in use. Value in use mean present value of future benefits or future cash flows. Suppose the carrying value of asset is 100. Fair value less cost to sell is 70. Value in use that is measured by company management is 100. How much impairment is required? No need for impairment because recoverable amount is also 100. Higher of. Okay, let's see what happened. During the year, Boston company impaired one of its factories. The carrying value of the asset attributable to the factory as a single cash generating unit totaled 3.6 million at the year end. So carrying value is what? 3.6 million. The fair value less cost of disposal, mean cost to sell, and the value in use were estimated to be 3 million and 3.5 million. So 3.5, what is a higher? 3.5. So 0.1 million mean 100,000 impairment is required. Is that okay? Million respectively, and according the asset were written down by 100,000 to reflect the impairment. Audit procedures revealed that management use growth rate attributable to the company as a whole to estimate value in use. Using growth rate attributable to the factory specifically, the audit team estimated the value in use to be 3.1 million. Value in use is what? Present value of future benefits. If you are discussing about one factory, so you need to discount cash flow of that factory rather than all the factory's cash flows. While using all the factory's cash flows, the value in use was 3.5. But if relating to that specific factory, the value in use is 3.1. In that case, the recoverable amount is what? Not 3.5, it is 3.1. The impairment required is not 1, it is 0.5. In fact, the impairment required is 0.5 relating to that specific factory growth rate, calculating value in use relating to that specific factory cash flows. They have recorded 0.1, this means 0.4 more impairment is required. Is that? So if management do not adjust the financial statement, this 400,000 is that percent of profit and that percent of total assets. See whether it is 5% or more of profit or not. 0.4 divided by 6.4. Multiply by 100. So this is 6.25% mean material. So if management do not adjust the financial statements will be materially misstated. Can we discuss this? Because the matter is this percent of total profit and hence material. So financial statements will be materially misstated. First, we need to discuss for IAS 36, impairment is required when carrying value is higher than recoverable amount. By recoverable amount mean higher of fair value less cost to sell and value in use. Here companies are having a carrying value of 3.6. Fair value less cost to sell is 3 million. But the value in use that is based on growth rate as a whole of the business, that is 3.5, while using growth rate specifically relating to this factor is 3.1. So recoverable amount is what? 3.1. So impairment requires is 0.5, while company have recorded 0.1. So 0.4 million more impairment is required, and this 0.4 million is 6.25% of profit and hence material. So if management do not adjust the financial statements are materially misstated. How many marks? 10 marks, 3 to 4 points. Number 2, borrowing cost. It look like meeting capital criteria. Interest charges of 75,000 relating to a loan taken out during the year to finance the construction of new manufacturing plant were included in finance charges recognized in profit for the year. In this finance was relating to construction of the new manufacturing plant. The manufacturing plant is due to for completion in November 20x6. What's the year end? December 20x5. This mean these are relating to during the construction time period, because all cost incurred before all cost incurred from start of construction till completion date should be capitalized, including borrowing cost. And this borrowing cost, if relating to this manufacturing plant borrowing, then it must be capitalized rather than expense out. For IAS 23 borrowing cost as well as IAS 16 PPA. So the 75,000 is that percent of profit and that percent of total asset and hence immaterial. Is that 75,000? Because that 400,000 was just material 6%. This is not even 100,000. This is 75,000. So this is immaterial. Even if management do not adjust this, financial statements will not be materially misstated. 2-3 points. Number 3, irrecoverable debt 65,000. One of Boston Company's largest customer, Cleveland Company, is experiencing financial difficulties. As the year end, Cleveland Company owed Boston Company 100,000, against which Boston Company made a 5% specific allowance. This means remaining 95,000. Shortly after the year end, Cleveland Company paid 30,000 of the outstanding amount. This means remaining 65,000. That still we need to recover. Due but has since experienced further problems, leading to their primary lending presenting a formal request that Cleveland Company could be liquidated. If successful, only secure creditors are likely to receive any reimbursement. Secure means bank loan provider. We are not secure loan provider. So, per IAS 10, post year end adjusting event, these receivables need to be adjusted against bad debts premium, because 100,000 minus 5% minus 30,000, 65,000 due balance, company is unable to recover. So if management do not adjust the financial statements, this 65,000 is that percent of profit and hence immaterial, will having no material misstatement in the financial statement. And there is no other information. There is no information about investment. So we have discussed part A for 10 marks, part B for 5 marks. Assuming that management does not adjust any of the misstatement, discuss the effect on the audit opinion and audit report. Combine. If we see the combined effect of all these, in P&L, we need 465 debit and 118,500 credit. In a net, what we require? 465,000 minus 118,500. So in a net, 346,500 debit is required in P&L, and a similar amount 346,500 credit is required in balance sheet. By combining all the effect, because misstatement we need to see individual as well as in aggregate. Though individual, only the number one impairment is having material effect, while borrowing cost and irrecoverable debt doesn't have any material effect. If we see the combined effect, 346,500, how much is that as compared to profit? 6.4 million divided by 400,000 multiplied by 100. So that is 5.4% just material, not pervasive. By combining all the four uncorrected misstatements, they are just 5.4% of profit, means just material, not pervasive. Even qualified opinion is required, not adverse. Though there are four misstatements, but the combined effect is just material to the profit. Even other three misstatements are, other than impairment, all other three are immaterial. Even with the combined effect, it just create a material effect rather than pervasive, so requiring qualified opinion rather than adverse. And the reason behind qualifying the report must be explained in basis for opinion paragraph. This we need to write down in part B. In what kind of report or opinion is required? And we have justified combined effect. How much is that percentage of total profit, whether material or pervasive? So just material. And this part we don't need to cover. And we have completed our reporting area. Tomorrow we are having class 2:30 to 5:30. We'll start the next area, ethical and other professional issues. The new area will start from tomorrow onward. That will continue in next 3 lectures. See you tomorrow then.
Okay, sir. Thank you. Good night, sir.
So we are having class tomorrow 2:30 to 5:30.